Brad Williams, Frugal Finance. We're going to get into some zeros, some present values, some coupon bonds, some futures in this session. There's 21 sessions, so buckle up. We're going to cover a lot of stuff here. Zero coupon bond, present value calculations, zero coupons. This is important. Why? Because in session 3, all I'm going to say is session 3 is just tough. All about zeros and bootstrapping. You got to have a solid understanding of zeros. Here's a brief introduction. As we work through this, you should feel a little more comfortable. Well, look, this is going to be a challenging session, period. 21 sessions, most of them are pretty straightforward, but when we get into bootstrapping, it's just number crunching. There are simple formulas, but the logic, well, it'll challenge you. With that being said, let's get started here. A zero coupon bond is a type of investment where you buy the bond at a lower price than its face value. When it matures, you receive the full face value. U.S. Treasuries sell at a discount. 1 month Treasuries will sell for 99.75. Face value minus interest would be the discounted amount. The difference between what you paid and what you get back is the interest you earn, all right? For example, if you buy a $1,000 bond for $950 and it matures in a year, the interest you earn is the $50 difference in what you paid in the face value. The yield or interest rate on this type of bond is the annualized rate of return for investors who hold it until maturity. If it's a 1-year bond, this will be a treasury bill. Treasury bills, notes, and bonds. Anything a year or less is a bill. Anything from 2 to 5 years, again, is a note. It may be 10 years. And then anything longer than that will be a bond. Not so for corporates, but we're talking about zeros. The yield on a pure discount bond is the annualized rate of return to investors who buy it and hold it until maturity. A yield on a 1-year pure discount bill equals face value minus price divided by price. So you got 50 divided by 950 equals 5.26. Don't get yield to maturity mixed up with yield. If you do, well, you're going to find yourself in a heap of trouble because you may be buying something that in the end, you're going to go, oops. If, however, the bond has a maturity different, and this is what's critical here, anything longer than a year, we would use the present value formula to find its annualized yield. Can't use this formula. Thus, suppose that we observe a 3-year discount bond, and this is where it gets really hairy. So the question is, where do these yields come from? They're going to be posted. This 3-year discount bond that promises to pay $1,000 each year and a price of, ? We would compute the annualized yield on this bond as the discount rate that makes its face value equal to price. I'm going to pause here for a second, and I'm going to show you what I'm talking about. Here on the right, this is from the U.S. Treasury. Right here, home, treasury.gov, policy issue, etc. They have daily Treasury par yield curve rates, and then they have a bunch of other information here that you can go through. Right here, you're going to see some yields. And you're going to see 1 month, 2 month, 3 month, 4 month. We'll look here. We have long, par, real long. They're saying par, but these are zeros. This would be your term structure. We have 1 month, 2 month, 3 month, 4 month, 6, 1, 2, 3, 5, 7, 10, 20, 30. And you can see as of 7/18/2024, the 1 month is at 548. The 30-year is 441. When we're looking at maturity, and you have to look at a yield. Here's the yield. We have 1 year would be 486, 2 year would be 446, the 3 year would be 424. To determine the price, this will give you a reference. From here, we'll continue. I'll explain what we're doing here. There's a reference to yields. 526, there are 2 ways to calculate. So we observe 3-year discount bond that promises to pay $100 each year and a price of whatever. We would compute the annualized yield on this bond as the discount rate that makes its face value equal to its price. There are 2 ways to calculate this. One, using the prices of the bond, and the other using the yields. So we just got the yield. Let's make that assumption. Both methods should give you the same results. If you tried to use the same discount rate for all 3 cash payments, you might end up with the wrong value. Each year's cash flow should be discounted using the yield corresponding to its maturity. That is absolutely 100% critical. Your source of information is important, and then make sure you're discounting proper maturity. Find the correct value for the bond. You might need to use trial and error to calculate the yield to maturity. Now, if you go back the previous collection of sessions or lessons, I showed an example where we priced this using some just purely math. We didn't use trial and error, but we used the yields. And I think we used the prices to come up with the same number. We're just going to go the simple route. We're just going to look at the information here, compute annualized yield. The prices of money market instruments to arrive at a correct value for the security. The first uses the price in the second column, and the second uses the yields in the third column. Procedure 1 multiplies each of the three promised cash payments by its corresponding per dollar price, then adds them up. Here we have 95, 88, 80, so you get 100 times 95, and you can see the math here. So we get 263. So you could do that. You go 95, 88, 80, and we get 263. The other is just to take this 100 and divide it by this yield. It will come up with a number, and that number should correspond to here, and then you do the same thing. Add them up. Pretty straightforward. It'd be a mistake to discount all three cash flows using the same 3-year yield of 772 right here. Why? Well, we would get a present value of 278, which is approximately, what is that, $16 difference? 8 and 8, $16 difference? That's big. So we'd have a huge discrepancy there. There'd be an arbitrage opportunity there because your mistake would be the market's reward. Remember, this is a zero-sum game. There's a winner and a loser. That's it. That's all Wall Street's about. There's a winner and a loser. Now, sometimes you'll win, sometimes you'll lose. Hopefully, you're at least 51%. Otherwise, get out of the market. Is there a single discount rate that we can use to discount all three? Well, yes. So what we have to do is find the yield to equal 263. The single discount rate is, and we're going to use trial and error right here. All I did was equal D46 because here's the formula. And we've used this time and time and time again. All we're doing is discounting this at each annualized yield. So we have 1 year, 2 year, 3 year. And we want to make sure we're using whatever rate. What we're doing here is all we're doing is 100 times 1 plus whatever this is. So you're going to play around until this equals as close as possible as this 263. You could fine tune this and go 6.8888. So it goes 263.00. That's it. That's the beginning part. Because we're going to use this pretty much the same approach when we get to bootstrapping, but it's a much more complicated process. Brad Williams, Frugal Finance. Thanks for watching.